Welcome back to another episode of the Entrepreneurial Edge, the Info Edge's Center for Entrepreneurship at Plaksha University's podcast. My name's Lisa, and today I have the pleasure of interviewing Professor Bhavish Sood, General Partner at Modulor Capital, Board Member at multiple companies, Rezo.ai, Dhurina, to name a few, and former Research Director at Gartner. Beyond investing, he also teaches corporate and business strategy and entrepreneurial finance here at Plaksha University, shaping how we students think about building scalable and resilient ventures. Thank you for joining us today, sir.
Thank you, Lisa. It's been a pleasure.
So, you've seen startups from both the inside and the investor seat. So, let's start there. In pre-seed or seed investments, there's very little to go on. What are some of the strongest proxy signals that you use to de-risk some of these early bets?
So one of my learnings has been, in my first fund, I started looking at investments. I came from the consulting and advisory world. And the mental model I would make is it on the Gartner hype cycle as a technology? Because, we were doing technology related investments. And I would say, if it's on the rise, then maybe, this is an emerging tech that needs to be supported. Because the VCs were taught that you need to support the emerging side of the technology. And then when I started having a lot of setbacks in my fund one, we started writing off a lot of investments. I realized the only indexing you can do is on the quality of the founder.
Okay.
Not on the technology, not on the business model. And I'll give you an example. We invested in a startup in the health tech space. This was a very pedigreed founder, had done senior product roles at US corporations, had top tier IIT, IM qualifications. And we started building what is typically now called as an electronic medical record for the health tech industry. Now, this was done with one of my batchmates who was an authority in the health tech space, a renowned dental surgeon, worked as a CIO at a lot of hospitals. And fast forward, COVID happened. And we thought this would be an adoption, we will see an adoption uptick. But the reverse happened. We actually transitioned from being a healthcare company or a health tech company to becoming a clinical company. We would use that technology for our own clinics, right?
Okay.
And this was a very interesting case for me because I learned that what you start with is not what you're going to end with. So the quality of the founder is the only barometer because business models change. There was a black swan event like COVID, which you couldn't predict. But if the quality of the founder is good, he will be able to transition the business model. Now, what those parameters are, that is tough to decipher. Now, fast forward, my latest investment, which we have not even announced, but money is wired, so I can talk about it. This is a company called Project Studio in the project and portfolio management space for the construction tech. And the only thing I saw in this was the founder had built on his own restaurants. He had done retail store layouts. So he was deeply familiar with the pain point of doing interior and designs. And based on that learning, he had started to build out this software. Now the mental model otherwise would be, look for a software founder who went to a top tier institute like yours and had coded and found a problem in some Reddit thread and started building it out. But the founder has no background in software, but he has enough of scars from his functional days of trying to build these stores out that he's in the best pole position to build something like this.
So what I'm hearing from you is, of course, the business is important, but it's also the person and the motivation behind it.
Yeah, and I'll tell you, when there is a lot of knowledge or gyan given out on how to build, how to pitch to VCs. But the core strength is why you are uniquely qualified to build this business is the only way to judge the quality of the founder. So if you built a beautiful design software and your background is in graphical art or in architecture or in interior design, you are in some sense uniquely qualified to build a product like that.
Understood. Interesting.
Yeah.
So you had talked about that pivot that you had to make with the
With
first,
Medimetry, yes, the first.
medical company. Can you tell us a little more about what that was like? How do you go about making this decision of making a pivot actually?
So it's interesting you say that. Now, in some earnest, I'll give you the example of Dunzo. Although it did go reach heights and then it eventually flamed out, was the first version of Dunzo was actually just a WhatsApp group. So we were, at Medimetry also we were over-architecting the product. We didn't have patients. We did not have a sales force which could sell to the clinics. We understood this as a pain point. Now, in the US also, EMR saw an adoption only after Obamacare came in. There was a regulatory tailwind behind that adoption.
Yeah.
The clinical side of the healthcare in the US was practically getting money to adopt it. There was no regulatory tailwind in the Indian case. So, doctors don't care. These products are too clunky. The good doctors have a power law applicable, so they have too much OPD. They don't have time to feed data into it. There's no triaging in the Indian system. There's no nurse who's taking your vitals, putting it in the system. We don't have that concept. So what we saw was that even though we had built a beautiful software, so the software was unlike any of the other EMRs in the country. So it had clinical protocols built in, it had a drug index, and obviously it had the clinical workflows. But still. So then we realized that if we became a healthcare company in the rural or the semi-rural side and where technology became a differentiator, that would be a more viable business model. So that's exactly what we did. But it ran into other issues because of COVID. But we actually became vertically integrated full health stack company. So we started doing tie-ups with pharma labs. We had our own software to do the clinical analysis, and we started controlling. So it already had telemedicine. So in the headquarters in Faridabad, patients from the rural market started dialing in. We went to the rural markets. We found a Karyana shop. We started giving him tablets, training him to get patients, and they would do a teleconnect. So we started thinking about how do you scale something like that. But healthcare software, we fundamentally understood no matter how beautifully you build, until somebody was subsidizing it. So either a pharma company would buy and give it to all the doctors or clinics. There was just no way to make money.
So we've touched upon, in the way I see it, two different kinds of topics, right? One is about how uniquely suited a founder is to solve a particular problem. And then the other is about this pivoting, right? So according to you, how does one balance both? Where is that line between balancing domain expertise and, adaptability and flexibility?
Yeah. So I think some of it, quite honestly, comes to you once you've started making investments.
Okay.
It also comes, quite honestly, from losing a lot of money, which I did. Both, quite honestly, some of it my LP, some of my own. So over a period of time, you get better, and it's sometimes not just easy to articulate how to look at that. But I would say the quality of the market and the quality of founder is maybe 70-75% of the evaluation criteria. So if you we had a good quality founder, but we had a very bad market. Because nobody was really buying software.
Understood.
Especially in the healthcare side. That is, by the way, still the case to a large extent.
So just going off of the market, right, in this case, if we look at solving for Bharat today, what unique opportunities or maybe constraints also, considering your experience, would you see for startups today focusing on beyond just metro or tier 1 cities? What should founders who are looking to solve for tier 2 or tier 3 keep in mind? Are there any problems that you see? Or
yeah. So we also have at my fund certain areas which we do. Medimetry was an example of that. I mean, they were in the semi-rural because we figured out in certain parts of some of the states, the nearest healthcare, primary healthcare, was also 80 to 100 kilometers.
Yeah.
There's no healthcare. We saw that as an opportunity. I have 2 investments currently in the edtech space who are covering there. So we saw gaps in the education, training, skill development side. We have a rural logistics aggregation company. We saw gaps there at my fund. Interestingly, we just exited a WeWork for tier 2, tier 3 cities because the quality of offices was not available. This is a company headquartered out of Chandigarh called MySoho, and they have like 2022, we led their seed round. I just exited to India Accelerator about a month ago. So, there are various areas to focus on, but when I look at it thematically, I would say logistics, education, especially on the skill set side, skill development side, are the 2 large, and healthcare. We see these 3 opportunities. Building a viable business model in all 3 is a very different beast altogether. My learning as a VC has been that rural markets have a lot of issues with respect to spending power.
Okay.
But the semi-rural tier 3 cities are, they are a decent opportunity from a monetization perspective. There is enough money also available there for spending.
Understood. Interesting. So we've talked a little bit about various problems and what a founder should have, qualities that a founder should have when trying to solve for these problems. Now, I have a question that's more with respect to founder and investor relationships.
Yeah.
So obviously, a founder who's very passionate about their problem, they'll come in with a certain mindset. I'm sure they'll have a certain plan, and you as an investor have a slightly different vision or a slightly different goal, right? So how do you maintain, how would you say a founder should go about maintaining that alignment with the investor? How transparent should they be when things are not going well, or how do you handle disputes in a situation like that?
So these things come up quite a lot, and I've gone to conferences where I've jokingly said having a VC is like having your mother-in-law come and live with you permanently. I say this out of a joke and a lot of people laugh, but I mean it with a lot of earnest. A VC, and I'll also give you some side that there are some VCs who like to do backseat driving. And quite honestly, I was like that in my first fund because maybe I was a novice and I was trying to learn. But the fundamental thing is that a VC cannot attach his skills to, even if it's at a strategy level, to the skills of the founding or the operating team. So if you feel that they lack in something, either in product or ability to build a business, you should ideally not be writing a check to them. That's the reality. Second, if you find, you can be a sounding board. So I'm reminded of what Khosla Ventures have. So in order to advise their founders, if you've not built and scaled a business, you are not allowed to do that. You have to live through their shoes. The Khosla founded Sun Microsystem, arguably one of the most important technology companies ever to come out. And his entire staff, I'm assuming all the VCs, all the GPs there have a strong operating background. So long story short, no backseat driving, is recommended. But yeah, VCs are supposed to be door openers. They should introduce them to other funds if they know, do client introductions if required, and more importantly or most importantly, maintain corporate governance standards. Most of the conflicts I've seen, whether it is my fund or other funds, are related to corporate governance and fraud.
Could you maybe elaborate on that? So, when would a founder and a VC have a falling out or have some sort of?
Sometimes it happens even at a strategy level.
Okay.
But in that case, unless the VC really has very strong background in that market, and is able to show or convince the founders. This is unfortunately a decision that the operating team needs to make.
Okay.
For various reasons. One, it is their startup. They have a lot more riding than just your capital.
Of course, yeah.
Right? A VC, if he loses an investment, he has 9, 10 or 15 other to recover. For an operator, that's his only way to ever make money, both at a salary level as well as on the equity level side. So any conflicts on the strategy level, ultimately I think the founders should be calling the shots.
Understood.
Yeah, this is a mistake a lot of VCs do, where they like to give. So be a counsel, present your data, but the eventual decision has to be the founders.
So you've mentored, I'm sure, as part of your investments, you would have mentored a fair amount of these founders, right? What is the most common pitfall that you see, or maybe I don't want to say mistake, but rather a piece of advice that you find yourself giving out time and time and again in various shapes of
So I think when you look at a public market, especially in the technology sector, capital allocation is job number one for a CEO, right? Whether you do M&A, you invest in new products, new markets, do buyback of shares, declare a dividend, there are multiple ways to do capital allocation. In the case of private markets, it is protecting the runway. That is the job number one of a CEO. If you have 18 to 24 months before you can raise a round, you only have one job. Make sure you try and hit those targets which will get you to the next round, otherwise you have to conserve your burn. That's the only place where I see people falter. And what happens because of that? If you don't adhere to that, you will end up raising money and you will dilute yourself. First, the chances of you getting money are very rare. If you do, it will be a down or a flat round. And then the issue is not getting the money, the issue is that dilution is permanent for a founder. So you will not hit your benchmarks.
And how would you incorporate scale into all of this? I mean, if I'm a founder, obviously I have to protect my runway, but I'm also looking to scale, right? I want to reach that.
That I think is that is the skill and discipline. The best founders find that balance between burn, and there are so when you look at the technology sector, the public side you have quality of earnings, right, which is well understood. On the private side, there are well-known benchmarks like Rule of 40, Rule of X, both by Bessemer Ventures, which give you a very good idea about how to balance growth and burn.
Understood. Is there any, maybe some sort of inflection point or some sort of benchmark that you've seen basis personal experience, after which there's that security that, okay, this is a venture that is going to scale?
I think there are multiple, so we keep talking about PMF, right? So the first PMF is usually about $1 million or $1.1 to $1.5 million. That's about 8 to 12 crores INR in the first 18 to 24 months. Then your second benchmark is 5 to 10 million. How do you hit that? And then the inflection point really is about between 30 to 50 range. Because once you hit anywhere between 30 to 50, the chances of you getting acquired on the M&A side also increase by the large majors. So when you look at large companies who are publicly listed, there are about 80 odd technology companies which are listed between NYC and NASDAQ. They look at anywhere. So if you are not an SME business, you are a large enterprise business in the software, they look at minimum of a $25 million kind of revenue for acquisition. If you're an SME focus, then they look at about 50 million. So the inflection points, these are typically the inflection points on the venture side. And obviously maintaining some sort of a semblance of burn to hit that. But technology sector, as you know, even if you look at the private ones, they are deeply loss making. And the market prioritizes growth because growth allows you to build more market share. So the valuation is all about growth. And then you have patches of capital protection. Once the zero interest rate regime went away, capital raising became very hard. Then people started stabilizing. And now because of the AI wave, software companies again are finding it very hard to raise money. So you have to be very careful not to get caught in the bad cycles also. because quite honestly, VCs today have a pick around being able to raise money.
So, if I'm a founder starting today, right, how would you advise me with respect to, and this could be any sector, but how would you advise me on what are some of the things that you think I should take into account if I'm considering raising a round? You know, what are some factors that a founder should consider in today's day and age with respect to being bootstrapped versus going out and looking for funding in the first place?
So I think understanding the first and foremost is understanding venture scale. Truly understanding, are you a cash flow based business or are you trying to build something venture scale? If it is venture scale and you ask this question, if it's venture scale, the VC is going to be always trying to see the growth, because based on growth you will get the next round. If you up market, then eventually if you do an up round after 3 or 4 rounds, I will be able to exit. If it's a cash flow based business, then the VCs are not interested, because they're not doing it for dividend. So understanding, and in every business, venture scale, or every segment of industry, the definition of venture scale changes dramatically.
So, considering today's AI boom,
Yeah,
what does that look like if I'm
it's a
someone?
very tough market, because some of the peers. So they're talking about 10 people, $1 billion companies now, which has historically been nearly impossible, right?
Yeah.
So even things like Gamma, which I use to create slides for the class which you
Yeah.
attend, they are on $50-60 million ARR. That is one. I think the second thing to watch out for is there is extreme power law happening in the funding also by category, right? Now, if you were trying to build an LLM, there is no way you'll be able to get money today, because that market has already the ship has already sailed on that market, right? And some of these Anthropic and all, they did seed rounds of $1 billion. I won't be surprised even in the public side, in the private side, companies start hitting $1 trillion valuations. It's happening in the public side. You have $1-2 trillion companies like Amazon, Nvidia, but some of the private companies are getting there. Like SpaceX is at 500 billion valuation. It's just a matter of time when you'll start having private companies also at $1 trillion valuations.
So, I mean, when you have founders coming in today and you have private and public companies that have achieved so much in a field like AI, right? How does someone distinguish themselves when they're pitching themselves to a VC? What are some of those 2 or 3 key indicators? You mentioned that the quality of the founder is one thing.
I think the circle of I look at circle of competence. What are some of the unique insights you have about that domain or sector or segment which nobody else in the market has? The design, the project and portfolio management software company, he had unique insights of trying to start restaurant fitting. Then he went and saw that same problem in the retail store while setting up retail stores for a retailer. That gave him unique view of 2 large segments where interior design happens. Because one is interior design, the other second is planogramming. He was uniquely qualified. Now that is one. The second is like the Reddit example I gave you, a software entrepreneur with right coding chops, and he found the problem on a Reddit thread and went and did it. My bias is going to be the founder who's lived through that problem. So at my fund, we value the domain experience way more than anything else. But it's not that, I also have investments in the conversational AI space. It doesn't mean that I will write a check to somebody who used to manage a call center. But somebody who's built voice models, in the as a data scientist, he would qualify there more. So depending on what kind of software you are making, the mental model changes.
Understood. So, how have your mental models changed when you're looking at investing in founders? or companies
Yeah,
over the years?
stop looking at again over-indexed on the founder. A quality of founder and a good target market is what I look at. And I have a very small fund, to be honest, in terms of just the actual dollars. What that also does is I also need to look for scrappy founders who will be able to build a large part of the software on their own or large part of the tech on their own. So more capital efficiency. So I think the criteria of founders, then having the right spread, making sure they have adequate money to able to reach the next round. So there are a lot of things which we do as part of the analysis.
Understood. Out of all of the companies that you've taken a look at over the years, or let's restrict this to the ones that you've had some sort of stake in. Which is the one company whose journey or whose evolution sort of really stuck for you? Maybe it was a really tough journey, or it was one that was entirely unexpected.
In a good way or a bad way?
Both.
In a good way, I think the conversational AI company we wrote a check to called Rezo. They raised, they're technically bootstrapped. They raised maybe I think 2.5 crores totally. They're in excess of 50 crores in revenue now. So we've had extreme power law kind of situations happen there also, and we've done some. I'm not going to name the founders who have struggled. It's not fair on my part to do that. But we've also seen some emerging tech companies having very cool tech, very good founders, but struggled because there's no market demand. So you also feel sorry for them because they have not given up, and they're still waiting for that inflection point to happen. Because technologies have an inflection point when it comes to adoption.
Yeah. So is there anything that can be done from the founder side when they find themselves in a position where they have, like you said, it's the right solution.
Yeah.
But it's maybe just not
the right time.
It's
very hard for me to say that, and it's very cruel also. But I tell a lot of the founders, there's no point putting your company on a ventilator. Eventually, you'll have to pull the plug. And it's not fair. And we've had situations where we have felt that the company could be revived. So we've done mass layoffs, we've protected the capital run, and now we're turning around some of those companies. But there are companies where we've told the founder that I don't think there's a market for something like this, and it's best we shut it down. And I've two companies which I've shut down. I've even gone out and found jobs for some of the founders. So, my mentor in the investment space, he told me, he said, "Tala bina khushi se lagao." So things happen. As long as the founders were ethical, you have to take the losses in your stride, and you model your investment models based on the power law because of that. Because and you can't predict. Some of the companies I had thought would do well, they've done reasonably well, but some of the ones which I had written off, they've done exceedingly well. And it's not in your control. Sometimes the markets make them. Sometimes the founders, delight you with their execution.
So, if I'm a founder starting off today, right, I understand that there are certain things that aren't in my control. But what is in my control is how I equip myself, the kind of experiences I give myself before I start off on an idea that excites me. For a college student today, or maybe even a high school student today, how would you advise them on, what are some of the things that they should focus on in terms of either building their skill, building their knowledge, in order to ensure that all of the factors that are within our control, we can push in our direction and give ourselves the tailwind?
The problem with that model is that if you keep researching, keep going out in the market, you see, with the AI tools today, especially if you're a software entrepreneur, the concept of MVP has changed, the minimal viable product. You no longer have to run a target group and show some prototype. Now you can actually build fairly decent prototypes using the vibe coding. Build something on vibe code, show it. If there's a buying interest, build more of it. And come back to the drawing board. So I think the iterations the cycle for iteration to build an MVP to get feedback from the market, that has got compressed. You have other very good guerrilla techniques, like you can build out in public today, where you can get some interest from initial, especially if you're in the consumer product space. So I think that has fundamentally changed. But if you're building something in the consumer AI side, which is where most of the generative AI product action is, whether it is text to video or it's voice models or any of these tech, you need, I would say, initial capitalization of in the tens of millions of dollars. But I'll give you an example. My favorite example is you look at voice recorders on calls, or voice bots. We thought that was a done space, right? But you look at companies like Granola, which have fundamentally brought out new products, and they have completely changed how you look at that entire category. And you suddenly realize that a lot of the older products that were there who would join the call were not good products fundamentally. They were not giving you the right type of analysis. And Granola did something very smart as a GTM. They found a niche in targeting VCs. Why? Because the VCs would take tons of calls, and then they would have portfolio. The portfolio would have customers, right? So they could actually build growth in that model. So innovation in a superior product, but another example I can think of is Google's Notebook LM. These are very interesting products, and you see and one of the things you see in consumer AI products today is the rapid iteration, how fast features get added, which was never there in the enterprise space.
Interesting, very interesting. So, if you had to sum it up, would you say it's maybe the unique qualities of the founder and their ability to rapidly iterate or prototype? Like, would you say those are the two
and I think the quality
elements?
Quality of the market. That's equally important. Now, couple of years ago, I'll give you an example. If you wanted to reinvent the CRM market, it would be hard to raise money. But now you have products like Atio and all, which are reimagining the entire CRM system from ground up. And they're getting money. I think they raised Series B or C, if I remember correctly. So, a lot of the older software legacy stack, especially those who have technical debt, will be rewritten, reauthored for the current environment, especially for the generative AI wave. So, it'll be interesting to watch how that trend happens and how VCs fund those segments, because existing product companies have huge distribution. They only have technical debt. Distribution is arguably harder to build than solving technical debt, because for technical debt you can throw people at the problem, right? Or you can throw tools.
Okay, I think that is all the time we have today.
Lovely chatting with you, Lisa, today.
It was a very, very insightful session. Thank you so much, sir.
Bye.